In 2008, Warren Buffett made a bet for $1 million that a hand-selected group of hedge funds could not outperform the S&P 500 index over a 10-year period. In 2018, Buffett won the bet and went home an extra $1 million richer, which I am sure was a very big deal for him. This exposed a big flaw in the investment industry, which is that actively managed funds, and in particular hedge funds, struggle to outperform the general market. When fees are considered, there is only a handful of funds that have returned money to their investors in excess of what they would have received had those investors just taken a more traditional investment approach. Hedge funds are also not open to the public. To invest in one of these institutions, what you need is to be called an accredited investor. What qualifies as an accredited investor varies between different countries, but here in the States, it is a person with an income of $200,000 per year or more, or a couple with a combined income of $300,000 a year or more, and this income must also be sustained over the recent 2-year period. A person or couple can also be an accredited investor if they have a net worth exceeding $1 million, excluding their primary residence. Finally, you can be an accredited investor if they are a director, executive, or general partner in the unregistered business they are investing in. This is simply to make it possible for people to invest in their own startups. You need to be an accredited investor to invest in risky assets, because the SEC wants to make sure that unsophisticated investors are not preyed upon by dubious financiers pushing complicated financial products with high fees and poor returns. Now, even if you are an accredited investor, you will still find it difficult to invest with most hedge funds. Most hedge funds will require a minimum investment of anywhere from $100,000 to $1 million. Ray Dalio's Bridgewater has an investment minimum of $7.5 million and charges up to $4 million a year in fees alone. On top of this, you have to be invited to invest in the fund, an honor which is typically given to people with an investable net worth of $7.5 billion or more. But people this rich are generally not stupid. So why would they invest in hedge funds when these funds have typically failed to outperform a more basic investment strategy? To find out why, it's time to learn how money works, which was made possible today by Trends, which is very appropriate considering their platform is built around understanding the business decisions of very successful people. Trends is a platform that feeds you ideas and then provides you access to a community and opportunities to turn those ideas into something successful. One Trends member took a report posted by Trends on the indoor plant business. Trends had uncovered signals that the indoor plant market was set to take off as people were spending more time inside. The Trends member decided to start a small business around this idea and leveraged the experience of business owners and investors in the Trends community. He used this feedback to fine-tune his business plan, and 40 days later, he was able to raise $1.5 million in funding to get the business started. Even if you are like me and you don't have ambitions of being a big-time entrepreneur, Trends can give you access to events where you will hear from industry leaders who have had all kinds of different yet successful careers. Trends is like joining the most prestigious golf club in the world without the headaches of needing to play golf. It's also much easier to get started with because Trends has made it possible for viewers of this channel to gain trial access for their community for 7 days for just $1. To take advantage of this offer, use the link trends.co/howmoneyworks. That's trends.co/howmoneyworks. Now, let's say that you do start a $1 million company and start earning more money than you know what to do with. Investing is probably a good option. No business lasts forever, and investing wisely can set you and your children's children up for life where they only work if they want to. You have plenty of options available to you. If you want to play it safe, then bonds have historically been your go-to, although with interest rates where they are right now, that isn't a very attractive option. Crypto is risky and unproven. It's hard to build generational wealth on a foundation which has only been around for a decade. Finally, there is real estate and the stock market, the two most generic investment options. They are popular for a reason. They offer great returns and have been doing so for as long as capitalism has been a thing. Today, it is easier than ever to get into, especially when you have millions, if not billions of dollars in the bank. But then there are hedge funds. On the surface, they just look like a middleman between you investing your money directly into the stock market yourself. A middleman that will take a very significant cut of any future earnings. So where's the value here? Well, the first mistake is thinking that this is a problem. Warren Buffett's famous $1 million bet may have made the hedge funds look bad, but it didn't reveal anything that sophisticated investors didn't already know. Okay, the markets outperformed these funds, so what? The market also outperformed bonds and real estate over the same period. Does that make bonds bad investments? No, of course not. They are just different. The second mistake is assuming that all hedge funds do is invest in the stock market. Some of them do, but not all of them. They also don't invest in the way that a regular individual would. When you and I buy a stock, we are usually planning to hold the stock because we think it's going to increase in value. If we want to get technical, we might even short a stock if we think that it's overvalued and likely to fall in price. Some of us will even play with stock derivatives like options, but we all know at this point it's little more than legalized gambling. Regardless of what we do as individual investors, we are just placing bets on a stock going up or down in price. Historically, the bet that most companies will become more valuable over time has been a good one, so that has become the traditional financial wisdom. Buy low-cost index funds and never sell them. There will be some years that are better than others, but so long as you hold a broad enough portfolio over a long enough time horizon, you are pretty much guaranteed to make money. This is very solid advice for 99.9% of people. When combined with some real estate holdings and a little dip into crypto and alternative investments, it can be a very powerful wealth building tool. But the 0.1% need something more. They need wealth that is constantly accumulating no matter what the market is doing. Good hedge funds should not be exposed to what investors call market risk. This is the risk inherent to investment caused by widespread downturns in the market. Almost every public stock, apart from a select few, are subject to market risk. If the market crashes, the stocks that make up the market crash with it, even if the underlying companies are doing just fine. There are two ways to get rid of this risk. The easiest way is to just wait it out. That's why people always say to invest for the long term. The other way is to hedge against market risk. Doing this is very complicated, but let's take a simple example. A hedge fund predicts Steam will corner the video game market on PC and consoles. With this knowledge, they will buy shares in Steam and short an equal value of shares in a collection of other companies like GameStop. This means that if the market crashes, then the losses from their position in Steam will be counteracted by their short positions in the other companies. They will have hedged their bet, hence the name. If Steam then announces that they will be partnering with Sony, Microsoft, and Nintendo to be the exclusive release platform for all video games, then the stock price will rally relative to these other companies, and they will make a profit off that news while not being exposed to market risk. This can still go horribly wrong. If meme lords on the internet decide that they like GameStop, then the hedge fund will lose money on that short. But that doesn't matter because that's just regular speculative risk, which doesn't matter so long as it's not market risk. So why is it so important to get rid of market risk? Because rich people are already exposed to that risk with their own businesses and all of their other investments. It's very hard to diversify away from market risk because most traditional investments are still correlated with the stock market. A stock market crash would likely dampen real estate prices and vice versa. Rich people are looking for uncorrelated return streams. If their hedge fund is having a bad year, then hopefully the market is doing better. If the market is down, then their hedge fund might be up. Investing in a group of uncorrelated investments is surprisingly more powerful than simply investing in whatever has the highest average returns over time. The math behind this principle is complicated, but it all has to do with a theory called dollar cost averaging. Dollar cost averaging assumes that an investor contributes a set amount of money at regular intervals into their portfolio regardless of market conditions. When the market is up, they will invest the same as when the market is down. This means the investor naturally buys more assets when the market is down than when the market is up, which automatically takes care of the buy low part of investing's golden rule. Having uncorrelated assets means that something will always be doing well while something else is doing poorly, which means dollar cost averaging can be fully utilized. Normal people usually invest for a single goal like retirement, so the broadness of their investments doesn't matter as much as the broadness of their time horizon. Rich people like to be able to access their money quickly to take advantage of opportunities as they present themselves. If a billionaire is presented an investment opportunity in the next Facebook, they don't want to pass it up because they are afraid of liquidating their portfolio while the market is down 30%. There is another reason that hedge funds are still around today, and that's because rich people like to think that they can pick a winner. Investing in a hedge fund is not like investing into the stock market. It is more like investing into a private business. Most businesses fail, just like most hedge funds underperform the market. But if you were lucky enough to invest into the Medallion Fund back when it was getting started, then you would almost certainly be a multi-millionaire today. For many wealthy people, that's enough of an incentive to write a few checks to promising new hedge fund managers with a decent investing thesis. Today, hedge funds are not nearly as popular as they were in the 80s and 90s. The fashion amongst billionaires is now private equity, but there is still a reason these businesses exist. They offer a very specific type of solution to a very specific type of individual. If you would like to learn more about the ins and outs of hedge funds, then you should go and check out Patrick Boyle here on YouTube. He is a hedge fund manager and financial author who makes criminally underrated videos here on YouTube. His videos helped me a lot when making this one, so make sure to